All right, good afternoon, everybody. Thanks for joining this month's installment of YCharts monthly webinar. My name is Caleb Epley. For those of you that have been listening to our webinars for several years, you might recognize me, but I'm back after a couple of year hiatus. And I'm back with a new format that we're pretty excited about. So joined with me today here is Jeff Kilburg. Most of you probably know Jeff from seeing him on CNBC, especially appearing on the halftime report. Jeff is a brilliant investor, extremely great market strategist, but also a longtime YCharts client. So we're excited to have him on with us today.
Well, too kind, Caleb. Thanks. Definitely excited about talking about it, Reclaim one day a week. But as my CNBC producer always talks about, I do have a face for radio, so this is perfect.
All right. Well, speaking of faces for radio, you can see my picture on there as well. But Jeff, along with your media presence, people might not be as familiar with your role with your firm, KCAM Financial. I was hoping you could spend just a moment talking about that and kind of what you are in charge of there.
Sure. Thanks, Caleb. KCAM Financial, I am the founder and CEO. We are an independent investment solution firm. We create research-based financial products. We provide portfolio management, risk mitigation solutions to a variety of folks, advisors, wealth advisory firms, family offices, and even institutions. So we're excited at KCAM because we offer distinct products utilizing dynamic stock selection, ETF model portfolio strategies, which we'll get into later, and also option overlay programs on a variety of different platforms, Caleb.
Great. So, Jeff, we at YCharts here, we work with financial advisors. We're talking to advisors almost every day, and it's just so clear that being an advisor is not getting easier. They're balancing so many different responsibilities, from managing their investments, working with their clients, but also running their business. And the landscape's not getting easier, and time isn't getting easier to find. So you couple that with all the work that you're doing with the media and your other responsibilities. How are you keeping this all together, and how are you staying on top of your game?
Well, Caleb, you hit the nail on the head. And the biggest commodity, the most precious commodity out there right now is time. And as advisors are faced with more and more asks from their clients, we really focus on how can you reclaim that time. And I think when we talk about how to simplify and scale your practice, we're constantly challenged with time management. I feel like sometimes like JoJo and the Circus Bear running around across the country, but I think it's really important to understand where you can find efficiencies in your practice, no matter if you're doing portfolio management as a small RA or if you're on a larger RA team at a wirehouse. So I think it's really important to understand, and I go back to Coach Holtz. If you don't know, I played football in Notre Dame, and there's an old joke, Caleb. If you walk into a room of 100 people and only one of those 100 people actually went to Notre Dame, how do you know? Don't worry, he'll come up and tell you. But nonetheless, when I was very fortunate enough in the 90s to play for Coach Holtz, he used an acronym which is applicable on and off the field. And the acronym was WIN, W-I-N. And that stood for what's important now. And I think what's important now for advisors and portfolio managers is to reclaim one day a week. Reclaim that time, because that time is so critical. And if you can find efficiencies in your practice, that will allow you to not only simplify, but to scale your practice.
Yeah, awesome, Jeff. I mean, we've been talking a lot over the last couple of weeks, kind of just in our normal conversations, but also getting ready for today. And you've reiterated that point so many times, that being efficient, having tools that work for you, having a process that you can rely on that's going to be consistent that you go back to time and time again. And you've kind of emphasized that by having a game plan, these challenges actually are opportunities for you and KKM to actually stand out, with these new challenges that have arisen.
No, that's right. And it's, this slide is perfect. We are doing more. There's more people asking us to do more, and it's certainly for less money, as we do see fee compression across the spectrum. And that's why it's really exciting to be talking about YCharts and how I use YCharts at KCAM Financial to not only explore types of efficiencies, but actually utilize them in our day-to-day practicality.
Great. And I'm excited to dig into that. So what we're actually going to spend the next 20 minutes or so doing here is we're going to dig into YCharts, and we're going to go through a few examples that Jeff's kind of shown me over the course of the last couple of weeks, how he leverages some of our tools and data, specifically looking at some of the monitoring that you do, obviously important with your media presence, but also excited to hear how you're actually discussing this information with your clients, some of the macro analysis, and then, of course, the models, which tie right back into those efficiencies. But, let's just jump right in.
No, for sure. And, when we talk about monitoring strategies, we run a lot of different sophisticated strategies. And if it's our ETF model portfolio that are powered by NASDAQ, Dorsey Wright, which are more technical in nature, we need to have one place, one spot to aggregate not just that one model, it's all of our models. And we do some bespoke work with some advisors, and YCharts has really become that solution for us. So if we do see a movement overnight in Asia, if we do see something come out of Europe, we have the ability to go to OneSpot, a web-based solution to really monitor our strategies, our model portfolios, and it gives us a really concise snapshot. Back in the day, Caleb, and I'm going to age myself here a little bit, but we really had to go to like 4 or 5 different websites to aggregate all that data. And that was it's just a time spent. And now for us to go in one snapshot and start the day, you know, if I'm going to CNBC out in England Cliffs, or if I'm just starting to get ready to prepare my day for either some portfolio construction or a meeting with a potential advisor that we work with, this is a really great starting spot of my day.
Great. And what we're looking at here, just full disclosure, Jeff, we didn't take your YCharts account and put it up here for everybody to see, so we'll let you keep some of your secret, but we did pull out a lot of components from the account that you have and from your dashboard and how you have it set up. So, you know, diving into a couple things, but right here on your dashboard, we're going to come back to the KKM sleeves in a little bit, but looking at the Essential 40, you know, one of the things that you showed me is how you've organized your data tab here to show some specific metrics that are important for you within this strategy.
For sure. As long as you just throw out a disclaimer and disclosure, these are the opinions of Jeff Kilburg, not of KKM Financial, the registered investment advisory firm. But yeah, you're absolutely right, Caleb. So we look at the Essential 40. This is what we call internally the modern day version of the Dow Jones. These are 40 names which we believe are to be essential and critical to the U.S. economy and the American way of life. But if we look at these tabs, and these tabs, what's great about YCharts is that we have the ability to organize it. I'm not smart enough to figure out all the different tabs, but what we do like to see is year-to-date total returns. And this kind of helps us understand the winners. And if you click again, you can see the dogs. And this is important in client conversations when folks are talking about, you know, what's dragging down, what's outperforming. And it's just a great way for us to see a cross-section of a specific portfolio like the Essential 40, but also it gives us a little bit of a knowledge. You know, what's the market cap? You know, this specific portfolio, Caleb, is large cap blend, more of a giant cap if you look at some of the names, but having that market cap under your thumb like Apple, Amazon. I know they were above $1 trillion earlier in 2018, but it's still nice to have that little nugget when you're going into a meeting, and also when you're comparing different names. It's great to see we like market cap, but it's also important to understand what that yield of that portfolio is, that dividend yield. We also like to look at year-over-year growth, and price to book is a metric my CFA really likes to utilize as well.
Sure. And Jeff, one of the things that I noticed when we were looking through here, you know, we were going through some of the names, and if I'm not wrong, one of the names you added to your strategy early this year is Palo Alto Networks, or PANW.
That's right. So tech. You know, we talk about this all the time on CNBC, and tech continues to be just a strong sector. It's actually the number one sector on our relative strength matrix, powered by NASDAQ Dorsey Wright. But when we talk about Palo Alto Networks, PANW, this is a name that came into the portfolio. So this portfolio is rebalanced annually. Typical turnover is about 5 to 10%. And we saw CBS and Charter Communications exit the 2018 portfolio. And then in January, Palo Alto Networks and Xylem. But Palo Alto has been a great name. We are seeing a little bit of blood today, down almost 2%, but still on a year-to-date perspective, this is almost up 30%. But this is a tech sector, and it's great to kind of understand, you know, here's a name that's seen interesting performance, but if you hit that performance, you can see where it's come from. And I really like this tab because not only is it going to show some of the comparables of FireEye, Symantec, NVIDIA, some of the names in this space, but it's also going to give you a longer snapshot so you can see, holy smokes, in 2014, it was on a tear. Then we saw a little bit of a downdraft in 2016. So the history of this is all presented to you in one click.
Yeah, certainly. And Jeff, I know, you know, looking at performance and some of the comparables is a big part of your process there, but I know from time to time you'll also look at the technicals and kind of see how those moving averages are holding up too, correct?
No, that's right. And, you know, a lot of the times we're looking at comparables as advisors are involved in another name or another security, another ETF, but I really like to understand the technicals of a specific stock holding in one of our portfolios, or any of our portfolios for that matter. And you can really see here how well Palo Alto Networks has respected that 50-day moving average. And that 50-day moving average is still holding tight here. 237.10 is that test level. But this is just one more reinforcing data point when we go into a meeting with an advisor, or if we're going on air talking about that. It's really important to understand where that specific stock is. And again, I can get this a couple clicks.
And then going back to some of the points you made earlier, right? Having a tool that is consistent, reliable, you know exactly where you're going to look for this data, hopefully allows you to do some of these things and still not spend all day looking at.
Well, that's right. That's right. And I think a lot of advisors out there who maybe are a little more hands-on in some of their client portfolios, if they have Palo Alto Networks as a holding, for example, they can see this has been a great stock. It's been on a great run, but maybe under 237, maybe it's time to trim some profits. Maybe it's time to book some profits and reduce that position or even close that position because maybe it has the ability to go from 237 down to 211. So it is interesting in this day and age. There's so much emotion in the market. I think it's important to strip out that emotion and tend to lean on the technicals a little bit more than usual. As we've seen, you know, it was Armageddon. Everyone was really concerned in Q4, and all of a sudden we're looking at all-time highs again. So that type of seesaw and emotion makes me tend to lean a little bit more on the technicals.
Sure. So I'm going to jump back to your dashboard quickly because I know
Let's do it.
We kind of went down a rabbit hole here from one of your strategies into a specific stock and kind of getting technical there. But let's jump into this second tab, which has some of the macroeconomic data on it. And I know that you mentioned kind of briefly when we first got started, you know, overnight you'll be looking at some things happening in the market and getting prepared for, you know, conversations you might be having either on the air with clients. But tell me a little bit about the data that you have here and how you use this.
Sure. And every advisor has a couple different metrics that they rely on. They like to have, you know, those arrows in their quiver. But I like looking at the 2-year, 10-year Treasury spread. My background, you know, back in the 90s was in the Treasury pits here in Chicago, at the Chicago Board of Trade. And I think it's a great measurement. I know a lot of people think that the bond market doesn't lead like it used to, but I still believe in that. Additionally, I like to know some of the important numbers that other institutions are looking at. That's non-farm payrolls. That's GDP. That's unemployment rate. So pick one if you want, Caleb, but let's look at, you know, one of these metrics which can help me dig a little bit deeper, either if I'm going on to talk about some of the data or if I'm getting ready for a meeting to get a better understanding of, and I know we always look at certain data points as a blended pulse or gauge of the economy, but there are certain numbers that I lean on more than others.
Sure. And I know in the past we've jumped a little bit into GDP. We've looked at employment numbers and jobs numbers that come out. But I know you were recently telling me one way that you use kind of oil production data and actually drill down into some of the companies that you hold from there. So I'd love to go through that example if we could.
Yeah, for sure. And I think, you know, a lot of people talk about U.S. crude oil is providing leadership. And I agree with that sentiment. If you look at last fall, when we saw that initial type of volatility that was from the 10-year note going from 3.05% up to 3.25%, what was the next thing? Where was the next ripple effect? Right. It was in crude oil. And all of a sudden you saw crude oil get sold off and you saw some of the oversupply and the weaker demand numbers be revealed, and that really pushed crude oil futures lower. So having a pulse on U.S. crude oil, I think was really important because the stocks were so correlated to it. It was maybe lock in step a couple weeks in the rears, but understanding some of these different metrics, it's great that I can go on YCharts here and get a better snapshot of U.S. crude oil production because, you know, crude oil, it can be convoluted sometimes when you see OPEC and non-OPEC members, but understanding that production, specifically here, the record historic increase in crude oil production domestically, that's an important narrative, which actually does, believe it or not, feed back into your stock allocations and your equity exposure.
Sure. And one of the things that you showed me too is, you know, kind of an easy example to see which companies that you know you hold that may have exposure to a change like this. I think we jumped into, you know, just XLE. And
for sure. XLE, the broader swath, this is the sector spider, which gives you some good exposure to the energy space. And what's interesting about this is, you know, 2018, people were, you know, trying to hide underneath a rock in the energy space. So this XLE was down about 18% in 2018. Now it's come back just roaring and really mitigated that drop. It's up about 19% on the year. But what's nice is that you can see where the top 10 holdings are in this. And, you know, these are names that you all know, Caleb. And these are, if you're not going to be selected into a certain name, you're more comfortable having a broader swath, I think it's great. But understanding all of these different ETFs, what the top 10 holdings are and what their weightings are.
Sure. And one of these that I recognize from one of your other strategies, I believe, is Chevron too. And they've been in the news recently with the Anadarko news, right?
Absolutely. That was a big deal last week. Chevron, they're basically doubling down on their bet on oil and gas production here domestically, and they offered to buy Anadarko, APC, for $33 billion in a combined stock and cash deal. And you saw a 32% jump that day in Anadarko. So Chevron continues to grow. They're going to be the second largest player in the space now with this acquisition, and it's fun to see that I can look at the news, the data, the chart, and also some of the risk metrics associated with a name like Chevron, who just splashed in the news last week.
Yeah, and I just love how it comes full circle too, right? Because we're looking at U.S. oil production. We're talking about Anadarko, who's a huge oil producer in the U.S., right back to Chevron, a core holding for you, and a conversation you can have with your clients.
It's all interlaced, and it really is interesting that I don't have to go to 6 different websites to aggregate that information and be as smart as you.
You're flattering me. And, all right. Kind of back to the dashboard here. I do want to now touch on what I think you've presented as the best way to get time back in your day. And some of the core model portfolios or sleeves that you use at KCAM as building up your different model strategies. So tell me a little bit about these model portfolios if you can, and then maybe we'll jump into one and actually look at how it's actually produced.
Sure. So, the drum that we continue to beat is how can we assist advisors in reclaiming one day a week? That's implementing a models-based practice. And what's interesting about this, Caleb, is that a lot of advisors, they're already utilizing models. Maybe they're in their head. Maybe they're not articulated into a spreadsheet and utilized in a more efficient manner. But these models that we utilize, and these models, let's look at the KCAM sector rotation model. This is powered by NASDAQ Dorsey Wright, 100% systematic, a technical approach to portfolio construction. And it's wonderful about this is that this can be a sleeve, like a satellite to a core position, or it can be utilized in totality as a large cap core holding. Instead of having securities, you have these ETFs. So we put our models in here, and this helps us understand where they're moving on a day-to-day basis, understands some of the sector, the top 10 holdings. So this page is great, and you can put as many, I believe you can, just put as many models as you want into that model upload, which is really simplistic even for a guy like myself to implement. And this is just great for us to have this all in one spot. But the KCAM sector rotation, we truly think is a more thoughtful sector exposure. In this day and age, I think as we see markets move, and certainly the Fed and central bankers are convoluting markets, I think it's really important to stick with sectors that are revealing strength, and more importantly, stay away from sectors that are revealing weakness.
Yeah, and I was actually really interested to look at that, right? So here we can obviously see the performance of the model against the S&P 500 kind of year to date. But if we click into the allocations tab, you start to see the really interesting aspects of the model, right? And that's when we can see exposures to certain sectors, but also how much you've stayed away completely from other sectors, which,
that's right.
As an allocator, somebody might be nervous to have no exposure at all to one sector. So tell me how you can be confident in a decision like that.
So we have confidence in the relative strength matrix that's powered by NASDAQ Dorsey Wright. But what's interesting to see is that technology, I know technology had a little bit of a repricing in Q4 of 2018, but technology continues to be the number one sector for us. What's interesting is that utilities has revealed strength, and that's typically not a type of sector that you would see in a bull market as it's approaching new all-time highs. But I think it's important, not if you want to have that SPY exposure, I just don't think that's the value add that you provide to your clients. So this is just an additive component of really being thoughtful in sector exposure, but also being dynamic, having the ability, the model has the ability to move in and out of sectors. And we did see a little bit of disruption. We saw an addition this year. We actually have 9 holdings in this now as one in the communications multimedia ETF. And that's something that the model produced, and it's a simple point and figure analysis. We're not overthinking. We're not thinking. This is all dictated by the 100% systematic. But this really does, I think, tilt portfolios for ideally some type of alpha driving component.
Sure. And, for you, Jeff, and for me, we might look at this and have a pretty good sense for how this sector exposure differs from the market in general. But you showed me something pretty cool the other day where you could actually compare your sector exposure to the S&P for conversations with your clients.
Right, and that's why we get asked a lot, why are you overweight technology? And, we pull up this chart here. A picture is worth 1,000 words. This may be worth 2,000 words, Caleb. And, we still in our matrix right now, powered by Dorsey Wright, the top 5 sectors are tech, consumer discretionary, utilities, communication services, healthcare, believe it or not, even though it's been a rough little bit of sledding. And then financials is number 6. And it's nice to see some of the earnings season, JP Morgan's and BlackRock and some of these other financial services companies hit. But this really kind of illuminates where we're exposed and where we're not.
Yeah, and you mentioned financials, you mentioned technology. One of the things that jumped out at me too with the big overweight is utilities. Maybe a sector that doesn't have a whole lot of sexiness to it. But
that's right, and I think it's amazing. Pigs get fat, hogs get slaughtered, Caleb. It's an old saying that we used to use in the pits at the Board of Trade. But the utilities being lit up as one of our stronger sectors is really interesting. I think that is a bit of a search of yield, a bit of a search of just in case the market doesn't have the ability to move like it did every quarter, like it did in Q1. So utilities is really interesting. If you click on IDU, you can see some of the names in there in that top 10 holdings. And we look at like a Duke Energy, which is also, believe it or not, an Essential 40 name. But these are names that have significant weights, have significant positions in the economy. But I think a lot of people see a portfolio that's contrasting. You have technology as an overweight, and then you also have utilities. But when they work in concert, that's the beauty of some type of proprietary strategy.
Sure. And, we've talked about that strategy so many times. And how much does the rule-based nature of your strategy help you not only to simplify your own practice, but also to simplify that communication point with your clients when you're explaining how you're investing?
Yeah, and I think that's important. No matter what models you're running, specifically the models we're running that are 100% systematic, I think it's important to articulate that message to that client. And maybe you have a more qualitative model than we have a quantitative model, but it's more important, write those rules down. If it's 3 bullet points, help your messaging to that client on how our model works and how it potentially will move into a time of stress and a time of euphoria. I think it's really important to really get your arms around that messaging so you can articulate it in a really succinct manner.
Great. So going back to some of the analysis that you can do on model portfolios here, and there's a lot you can see with different exposures. You can tell a lot of the story, Jeff. But I know some of the models you run are pretty sophisticated, and there's certainly aspects of those models that we can't dig into in a tool like the comp tables here on the YCharts. So how do you go about managing some of the more complicated or very technical aspects of your models?
Well, that's right. We do utilize a variety of sophisticated approaches to portfolio construction, and we try to optimize, Caleb, and we're trying to discover. We're trying to always implement as many efficiencies as possible. And fortunately, this is where YCharts really helps us out. You guys have a flamethrower in your bullpen. His name's Rushi, and Rushi's just a rock star. But Rushi, as well as some other of your colleagues at YCharts, can help us really implement some of these efficiencies. And as good as my team is in Excel, we still have some wrinkles that need to be ironed out. So we've actually used some YCharts add-ins and help us kind of mainstream that. Because what does this all mean in layman's terms? If we have a change in our KKM sector rotation, that specific strategy is the nuts and bolts of many other different strategies in some of our risk-based models. So one change can essentially affect and ripple into 5 or 6 different strategies. Well, you guys helped us out and built that spreadsheet out so that one change in KKM sector rotation feeds into the other one. That would have taken my team probably just a couple hours to update, but now it's happening in a matter of seconds. So again, efficiencies. We just reclaimed a couple hours in that specific example. So I think it's great, and I still haven't been able to stump Rushi and his team yet, but I'm going to try in 2019, but we keep on asking for additional synergies and implementation of the efficiencies, and I think you should be doing the same.
Yeah, great. And you mentioned Rushi. For those listening in that don't know who Rushi is, Rushi's on our modeling team. That team, I've yet to stump them either, Jeff. So if you do, let me know. But
you got it.
Anybody that is a professional subscriber to YCharts can leverage Rushi and his team and have us help with some Excel models. So certainly encourage you to reach out if you're listening and haven't done that yet in the past.
For sure.
So let's go back to kind of our presentation here quickly and talk about a couple of these key points, right? So at risk of kind of, I guess, killing a dead horse here, right? But, having that consistent, reliable process, having things that save you time, keep your practice efficiency, and then simplifying where you can so that you really can scale and grow. Just one more time, a couple things in each category maybe that we can focus on.
Sure, and I think this is really important. If you take anything away from this webinar, I think it's really important to understand if you can create a consistent or reliable process, not only is your compliance officer going to have a big smile on his face, but you also have the ability to scale. That consistent, repeatable process, now that it's implemented, you just reduced a lot of the time of onboarding new clients. So I think that's really important. And if you have 9 or 12 different models, you put those on paper on an Excel spreadsheet and have Rushi put a little polish on it, but nonetheless, you put those in writing. Now you have this consistent, reliable process on how to navigate moving forward. And I can't harp on this enough, but this is really important as we move in with all the different regulations coming at us. This is going to help compliance. This is going to help strengthen your whole firm.
And speaking of that, right, so we've talked about model portfolios a few times. Jeff, I know in other times I've heard you speak about models, you talk about the different ways to get exposure to them, whether that's, buying a model that's going to be managed for some of your practice, building your own models, or subscribing to models that you can follow kind of through your own systems. But regardless of which that is, and maybe talking about where each of those strategies might make sense, but you've put together some pretty impressive analysis on how much that can actually add to a practice.
For sure, and I think it's really, the overarching theme here is how do we simplify to potentially scale? And I'm actually writing a book right now called Reclaim One Day a Week for all the advisors out there. But I think this is really important. If you kind of see in the numbers, we all love chewing on data. If you can see by, just like every endowment or institution utilizes models, either a full outsourced OCIO endeavor, or if it's simply an advisor who has models that they're utilizing, just getting them articulated to be able to utilize. And you can use models in an SMA format or a UMA format, and the UMA, as you know, Caleb, is taking 4 or 5 different strategies or manuals and implementing them into one of your models called a risk-based moderate model. But nonetheless, if you can reclaim 450 hours a day, that's sensational. That's 1 day a week that you can focus on existing clients, or on this slide, prospective clients. That's 75 more prospective meetings a year, translates into 43 more clients in theory. But this is real money. This is real time. And if you can create $11 million in assets, that's over 6 figures in fees that's coming into your firm. But what's important is that we go back to Cerulli did a study for us, and this was to really understand how much time that advisors are spending on all the different parts of the process in portfolio management, administration, and by really moving forward, a client, you can grow this 23%. And I think it's imperative to understand that it could be daunting. It could be really tough to challenge and try to get everything implemented into a models-based practice. But I think if you start slow, there's a lot of ways to move that. Maybe it's just your smaller accounts initially, Caleb. You take some of your retirement accounts under $250,000 and you implement those into some of the models that you and your team have created. And that's the bridge that gets you from where you are to that models-based practice. And in that models-based practice, we have imperative data here to really prove the fact that you can scale a business if you implement models-based practice. And we like ETF model portfolios, but of course you can utilize a couple different strategies into that.
I think you actually told me a story the other day too, Jeff, about a client or a prospect that you were working with that they were using models, but the models were just in their head, right? It's just a matter of not necessarily reshaping your whole practice into this entirely different type of strategy,
That's
but
right.
just taking those models and getting them structured so that you can implement them systematically.
That's right. And this is not taking away the decision-making of an advisor. This is simply articulating decisions they've been making for 10, 20, 30 years and formalizing it. And we're working with a great advisor group out of Davenport, Iowa. They manage a couple $100 million, and they've been utilizing models in their head for decades. And now we're helping them to structure this and provide this infrastructure so moving forward, they understand here are 3 different risk scores for clients. Here's 3 different buckets inside of those risk scores. Now we have 9 strategies. And of course, you want to have a little bit of ability to be more bespoke and either dial up or dial down risk tolerance. But now they have 9 strategies in a models-based practice. And now when they take in more assets, it's not, they don't have to overthink, they don't have to spend too much time. It's going to fit into one of these buckets. So it's just a formalization of the thoughts they already had in their head and the way they were already managing money for decades.
That's great. So I do want to, if we can, leave some time for Q&A before we open it up to any questions that might have come on, over the chat throughout the webinar that we weren't able to get to with the support team here. I've got a couple for you. First of all, so looking at the market this year, you already talked about how we saw some volatility in the end of last year, and then we've essentially recovered from that volatility. But I'm curious what themes and what trends you see happening in the market throughout the rest of the year.
Well, it's interesting. The Fed changed the narrative of 2019. If we rewind to early December before we saw a lot of the chaos hit the markets and the market sell off down to under 23.25 in the S&P 500, the Fed was on pace to raise rates 3 times in 2019. That narrative has really flipped, and now you've seen in Q1 they bought equities and they bought bonds. You've seen the 10-year at 2.5%. You're seeing the equities about 1% away from all-time highs, specifically in the S&P 500. But I think in 2019, if you can get the sectors right, I think you're going to really be a value add to your client, because I think we will see additional volatility. We talk about once the toothpaste is out of the tube, Caleb, it's hard to get back in. And I know the VIX is at 12. I know everyone's feeling pretty good about new all-time highs, but I do think that if it's a It's a curveball coming out of China-U.S. trade deals, which I eventually do believe will get ironed out, and I think it'll be really productive for our economy in the stock market. But right now, I think there's a couple things on the horizon that we just haven't figured out yet. So I expect a little bit of choppiness here, but by and large, the economy's in a pretty decent place.
So you mentioned, when you first started answering that question, the Fed and interest rates. Jeff, you're pretty famous for several years ago kind of predicting the downturn in the 10-year note and predicting that yield selling off. So I'm curious, what other bold predictions do you have moving forward that we can hang our hat on?
Well, I don't think I'm going back to when I claimed, we're going to take out the old historic low of 1.67%. But I do think it's interesting if you look at the 10-year note, and I do lean on the U.S. Treasury market to provide some type of leadership for the market. But I do see, and I will say that I think the 10-year note goes closer to 2%, and if not touches 2%, before it goes to 3%. And I think that's a big deal. And I think if you understand the landscape of that call, this is by and large the fact that central bankers globally, ECB, the Bank of Japan, the Federal Reserve here, they're in a coordinated effort. And I think they really want to see the short end of the curve move higher like they have. But that long end of the curve, 2.5%, that's a pretty juicy yield in comparison to the German boom, the German 10-year boom.
Sure.
So I think those longer rates stay low. And I think the Fed wants that because that's going to, 2018 was a pretty tough year for real estate and housing. And all of a sudden, these lower rates, these refinances, it's going to put a little wind in the sails. So I think this is very much on purpose. But I think the 10-year goes closer to 2% than 3% in 2019.
So tying that back a little bit, talking about that 10-year yield going even lower, when you were talking about being in the right sectors, it's going to be huge this year. And we're also talking about a little bit of exposure in one of your portfolios to utilities. Do you think those higher yielding stocks are something that people are going to be looking for when they're seeking yield with bond yields so low?
Yeah, I think it's, you have to be really careful when you're talking about high yielding stocks because sometimes a stock may be kicking off a 5 or 6% dividend, AT&T, for example, and it loses, 15, 25% of its market value. So I think it's really important to understand what that yield is and that security you're looking for. But I do think that the continued search for yield will allow some opportunities. And I think you'll see if it's high yield, if it's shorter duration bonds, you're seeing finally for the first time in a decade, some of those shorter duration bonds, if it's high yield or if it's government, they're rewarding investors. And it is interesting to see how with that 10-year lower, it is really kind of confusing some people where markets are going. Because if I would have told you back in 2009, Caleb, that in 2019 would be at 2.5% of the 10-year, you would have looked at me like I had three heads. We're supposed to be at 4%, 4.5%. We're supposed to be in rates normalizing. I don't think rates normalize in our lifetime, to be honest.
All right. So I do have a question here from somebody that was listening, and I think maybe we can answer this in tandem. But the question was, this listener said that models are something that they really appreciate for showing static portfolios. But when they're trying to demonstrate a tactical model, how are you explaining how that model changes over time and really demonstrating to your client how those tactical changes affect your model and explaining that strategy kind of clearly to them?
Well, that's right. And, that's one of the things that I know YCharts is working on the ETF model portfolios to have that dynamic. But what we have built inside of KKM is all our models, which are running real money in live accounts. We have the ability to reveal and show those different model changes. So it is 100% dynamic from that perspective. Hopefully I'm answering that person's question, but if not, they can always circle back with you or myself.
Yeah, of course. And just to add to that too, I know, having, my role on the product side here at YCharts, I know we're actually working on a lot of developments on that side too to be able to show some of those more tactical changes to models. But I'd also, make another plug for our modeling team that does work within Excel to do some model work here in that regard too, where we certainly help clients out.
No, that's right. And that's where Rushi and team have come in and thrown that 100-mile-per-hour fastball to help us find that solution.
Exactly. All right, well, I'm going to take time for one more audience question, and I've got one more of my own for you. But somebody listening is asking, what data specifically, or maybe some of the data series that you really like to look at that help you anticipate changes in market direction, both here in the U.S. as well as markets around the world.
Well, if we can go back to the data tab, this would be great. But I really like to have a good understanding of GDP. And some people argue that GDP is a rear view mirror perspective, but I think GDP kind of tells us a lot. We also look at payrolls because, these may be boring numbers, but I have news for you. This is what the Federal Reserve, this is what the central bankers globally are looking at. They're looking at these data points. They're looking at inflation gauge, looking at PMI. All this goes into their matrix, and you can argue that they have a third mandate now of keeping the stock market up. But nonetheless, these data points are really important. And when you see the data points sour, you see Fed policy flip. So you can customize this page here for all the variety of different points that you want, but I lean a lot on GDP. I like PCE. I also like sentiment. And as much as I dislike the University of Michigan and the Wolverines, because I am still a little, I enjoyed the ride, but I should leave it there. But nonetheless, that sentiment index is important to put into your component of your formula of how you're building portfolios. This is all critical, and there's certainly different measurements out there, but this is all important pieces of the puzzle for us.
Yeah, and I imagine this changes from time to time too as market cycles change, right? I know, for instance, the 10-2-year spread is something that we've been seeing in the news a lot. You know, you were a bond trader a while ago. I was a bond trader several years ago too, and if you asked anybody about these yield spreads, nobody really knew what you were talking about.
That's right, and now everyone's an expert on the 2-year, 10-year. They talked about inversion recently, and we don't really look at 3-month bills inverting with the 10-year to be anything of significance. But I think it is important to understand that 2-year, 10-year spread, help better understand how banks are potentially making money on net interest margin, which is a key input. And we look at financials in a broader swath to help us understand leadership of markets. And yeah, XLF has been dragging the S&P 500, but now we're in earnings season and they're still making money somehow. So I think all that goes back to the 2-year, 10-year spread. I think it's important to understand and help you get a better picture.
All right. So last question for you, and for anybody listening that doesn't know, our CEO, Sean Brown, also a fellow Domer, he insisted that I ask you if we'll be seeing the Fighting Irish in the college football playoff this year.
Well, shout out to Sean. Sean's the best. But unequivocally, yes. I was actually at the Cotton Bowl where we kind of gave Clemson a good run for their money, and then they spanked Alabama. But I think the answer is yes to that. But I go back to Coach Holtz, and I was very fortunate to play for him back in the 90s, and he always talked about having a plan, and he had a plan. It was literally in our meeting room. He had a plan up, and we stuck to the plan. No matter what the volatility, adversity that was faced to us on the field, it's so important to have a plan. So if you're an advisory firm, you're growing, if you're already established, I think you have that plan, you stick to that plan. Everything else works its way out, but you have to have a plan and be able to stick it in good times and bad.
All right, so I'm going to wrap up with your closing thoughts, which sound like, the economy's strong, but being in the right sectors this year is going to be important. The 10-year yield's going to probably go lower before we see it go higher, and undoubtedly you're going to see the Irish in the college football playoff.
I think you hit the nail on the head, my friend.
All right, well, thanks so much for everybody that joined us today. Jeff, thank you so much for joining us. Excited to hear the feedback, but I certainly enjoyed a chance to sit down with you and learn a little bit more how an expert like yourself uses YCharts. So thanks for joining us.
Thanks to you and all the folks at YCharts. You guys are great.
All right.